Hey guys, welcome to the second video of the investment banking question discussions. In the last video, we discussed about the different methods of the expense model, and apart from that, the accounting methods of the different things. So as we discussed, like the accounting is the base of everything. On the basis of that, the financial model we prepare are working flow, or we can say that as a benchmark for the company's revenue. And the retained earnings is something like that. It's the old retained earning balance plus net income minus dividend issued. So this is something like that. If you calculate the retained earning for the current year, or you can take the last year's retained earning number that add to this year's net income, then subtract the company's paid out dividend. So this will go hand by hand for the marketing flows as well. Let's say retain earning is old retain earning balance plus net income we add. Let's say you have the 100 rupees as a retain earning balance right now, and we add the 20 rupees on net income, and dividend issued is 10 rupees. So 1110 will be the complex one. So 1110 will be the next number for them, and you can say that 1110 will be the number of calculated number. If you're calculating the retained earning for the current year, then take the last year retained earning numbers and add this to the net income. So and subtract the how much revenue they paid out in dividend. So this is kind of the retained earning balance. So let me walk me through about the what flows in the additional paid in capital right now. So it's a old APIC. So we can say that the 100 rupees are the old APIC. Then we can say that the 20 rupees are the stock based compensation for them, and the 10 rupees are the value of the stock created by the option and the exercise expense. So it's the 130 is the total expense for them, and we can take the balance from the last year as well and add this year to the stock compensation. Let's say this is the last year balance. This we can include in a stock compensation, and this 10 rupees are the value of the stock created by the option exercise. So we can say that the 130 is the total additional paid in capital for the particular company. So what's the statement of shareholders equity, and why do we use it? So the statement show everything. Let's say it's everything in the number. Like we have the major items like the comprise of the shareholders equity, and how we arrive at the each of number using the number elsewhere in the statement. So you don't use it too much. Like it will be helpful for analyzing the companies with the unusual stock based compensation, and that's the stock option situations as well. So what are the examples of non-recurring charges? And we need to add back to the company's EBITDA and the EBIT as well while looking at the financial statement. So we can say that the restructuring charges are one that we can include as a EBIT by EBITDA, or we can say that the EBIT to find out the numbers. Then we have the goodwill impairments, asset write-downs, bad debt expense, legal expenses, disaster expenses, and change in accounting procedure. So these are the charges we have to add it on the EBITDA, because these are non recurring charges for any of the. So it needs to be affect the operating income on the income statement, and if you have the one of the those charges below the line, then you have to click it or add it back to the EBITDA or EBIT calculations. And if you have to add back to the depreciation, amortization, and sometime stock based compensation for the EBITDA, then these are the not non-recurring charges. The company have to incur them every year, so these are the non just cash charges. So this is one thing like that. Next is how do we project the balance sheet items like account receivables and accrued expenses in a three statement model. So normally you make the very simple assumptions and assume that these are the percentage of revenue, operating expense, and the cost of goods sold. So accounting, you can say that this is as a percentage of revenue. Deferred revenue, we can say that is a percentage of revenue. Account payable, it's a percentage of COGS. Accrued expenses, it's a percentage of operating expenses, or SNGA. Then you either carry the same percentage across in the future, or you can say that assume the slight change depending on the company. So this will go hand by hand to defend the another things are there. This is one thing, and the another thing that how should you project the depreciation capital expenditure. So this is a simple way, like the project this as a percentage of revenue of the previous PPE balance. So this is one thing like that. That's a depreciation and capital expenditure. It's depend go in hand, and the percentage of revenue PPE balances. These are the different numbers. So there's a complex way for this as well. It's a create a PPE schedule that split out the different assets by their useful lives, etc. You can assume the straight line depreciation or the each asset's useful life, and then you can assume that the capital expenditure based on the what the companies have invested historically. So that's one thing we are working right now. Apart from that, we have to work on the financial models for the different company, and these are the investment backing for the everything. For the next update, let me in the next video for the different working sessions.